So what are the different investment styles that are out there beyond just value investing? Hi, my name is Gary Mashures. I'm the managing partner and chief investment officer of Silver Ring Value Partners. I also teach the value investing seminar at the FW Olin Graduate School of Business. So I think, this is a question that I got asked recently, and it's a good one because I sometimes feel like value investors act as if they're in a cult, right? And in a cult, or in a like religion, you're not supposed to, there's the one true faith, right? Anything that disagrees with your approach is wrong, and only the true believers are part of the in group, and everyone else is kind of on the outside, and they're the enemy, or they're somehow threatening what you believe. And I think that that's not the right mental model for you to have as far as investing goes. So I think that it's actually very helpful, healthy to study alternative investment approaches. And the part it helps you understand a little bit better of where, which direction you want to pursue and where you want to go as an investor. And partly, I think it helps you understand your own approach a bit better and why it's particularly suited to your strengths and weaknesses. And I think it is about, what approach, fits you as an investor, and not just that there's one approach that's great and everything else is terrible. So let me give you kind of a hierarchy of investment styles or approaches. So I think at the very top, if you think of it as a decision tree, kind of branches, going, left, right. So at the very top of that tree is, are you trying to answer in your investment approach whether a certain security is going to be at a certain price based on what others believe? So where will security prices go for whatever reason? And we can get into the details at the next kind of level of the hierarchy. Or are you trying to figure out kind of where what would the business be worth if there were no securities market, right? So I think that that's kind of a big distinction. So let's go for in the first branch and think about that. So, so what are some examples of approaches that try to figure out where will security prices go and why might they work or not work, right? So one approach that, the old kind of technical analysis or chart reading approach. So what's the basis? The theory is that you could study past, stock price behavior, maybe or other securities, and additional information, maybe volume and so forth. Maybe you overlay with events or whatever it is, and that somehow allows you to figure out where security price will go into the future. So no consideration is given to fundamentals. It's just purely based on behavior. Now, what's the logic underpinning? Why should this work? And let's suspend the disbelief for a second. And one of the reasons it could work is that you basically have people who are fallible, like you and me. We make behavioral mistakes, and maybe those behavioral mistakes fall into certain patterns, and maybe there's a way to kind of find those patterns in charts, right? I think that's I personally don't subscribe to that view. I think that's a hard way to make money if it's at all possible, but that's kind of the belief and that's the logic. And again, the thought process, the rationale is that, hey, we can find patterns of past behavior of securities markets participants that essentially guide us to where security price will be priced in the future. Now, a much more sophisticated version of that approach is kind of the quant, approach recently practiced by firms such as Renaissance, right? And if you read the biography of Jim Simmons that came out, I think last year or earlier this year, I forget. And again, it's not like I have firsthand knowledge, but my understanding is essentially they're programming computers using very sophisticated statistical models to basically discern behavior of people reflected in prices. And again, a simple example might be, and I don't even know if this is true or not, but let's say we all get a little grumpy a little before lunch, we kind of are impatient, our decision making is not its best, and we want to just go and eat our sandwich or salad or whatever we're going to have. And so maybe we're a little more pessimistic and more liable to sell securities before lunch. And then maybe after we eat that nice big meal, we're happy and we come back, maybe we're in a good mood and we are bound to be buying the securities a little bit more. Now, it's such a weak signal that unless you have a giant microscope, which is what their quant models and computers are, you can't see that pattern with the naked eye. But perhaps a pattern like that, or many others out there, which occurs over a span of a few hours, right? You don't care about cash flows or assets or anything like that. You just care about it. Does a pattern exist, and can you take advantage of it, right? And so I think that is an example of a technique that underlying it is the assumption that you can use certain information to predict where market participants will price securities in the future. And usually it's the near future. Let's actually take another third approach, which is you basically have you know people who use valuation statistics, right? And now some people confuse that for a value investing approach. It really is not. So a logic, I worked early in my career with some PMs who thought they were value investors because they would pull up the 20-year history of a stock price to earnings ratio, let's say, and say, well, this stock has traded 17 times earnings in the past, on average over the last 10 and 20 years, and now it's at 12 times earnings. So I'm going to buy it because it should trade at 17. So it sounds like this might be a value investing approach, but it is not. I'm sorry, it is just not. All it is now you're trying to use a different criteria. Instead of stock prices, you're using a valuation metric to predict where others will price that security in some not too distant future. Because no thought has been given to, has the business changed? Has the industry changed? Is the company more mature? What have you? There's no real fundamental analysis. It's purely a observation of past history, an assumption that the market participants will, essentially reflect that same history again in the future. Again, could be true, could be not true, but it's not a fundamental value approach. It's another way of predicting where others will price securities. And the fourth example of the approach is kind of the classical momentum approach, where who is going to beat earnings? Now, again, the idea isn't, well, the company is going to exceed estimates and therefore it's much more valuable than I thought. The idea is not that. The idea is that who's going to raise guidance or have a quarter that's better than expected? Why do we care? We care because other people will bid up the stock. So again, we're using, in this case, fundamental information, not to value the business at all, but to essentially try to take a educated guess on how other market participants will price its security. So all of these approaches, they're in that left branch, if you will, where essentially you're using different kinds of information to predict where other participants will price securities. And I would say in the right side of the tree, the other branch is a true fundamental approach. Now, and that is a very different way to classify things, because I think that fundamental approach, or an intrinsic value approach, so to speak, encompasses both growing companies and mature companies. So, in there, you could have an approach which takes a mature company and says, what's the net present value of its cash flows? And that's what the intrinsic value is. And by the way, it's always in a range. We don't know the future with certainty. And then we try to buy it with a big margin of safety, on the understanding that even if the markets were to shut down, our internal rate of return, if we were to own the whole business, would be quite satisfactory if we receive the cash flow stream that we estimate. So now we derive our victory, so to speak, not based on the actions of other participants in the market, but our victory is based on whether or not we are approximately right in understanding the company's future fundamentals. And a very similar approach is going to be to a very young company that's growing rapidly, and it's kind of the Phil Fisher, if you will, branch of value investing. And in that case, maybe cash flows are meager now, but there's a huge addressable market, it's a great management team, great culture, a strong competitive advantage, all those great things, and the company is going to compound, invest, and going to generate a lot of cash flow in the future. Again, that's very different from saying, hey, other market participants like SaaS companies, and they're going to pay 20 times revenue, and this one has a 15, so it's going to go up to 20. That's in the left branch. In the right branch, we're saying, hey, this is a very powerful business that's going to generate a lot of free cash flow. It's just going to be a bit out, maybe 4, 5, 10 years out. But if we even wait that long, we still get a very high value of discounted cash flows from this business, and therefore it's worth much more than the securities it's trading for today. So again, I think the way to classify approaches is not growth versus value. It's really, the main distinction is someone trying to estimate the business value, or is someone trying to estimate what market participants will do to security prices? And then within each of those two branches, there are distinctions of how do you approach that. But that's the main classification I would say is the most relevant. I hope this has been helpful to you. If it has, please hit like and subscribe to my YouTube channel. Thank you, guys.